Welcome to the Mike Dillard Podcast, where entrepreneurs get the knowledge and skills that you need to bring your dreams to life. Welcome back, gang. Today, we're joined by my good friend and one of the most knowledgeable CPAs out there, Mr. Tom Wheelwright. So Tom is the official CPA advisor for Robert Kiyosaki and the Rich Dad brand, but he's more than just an ordinary accountant. He is also skilled in entrepreneurship as a business owner himself and wealth building, which is a very, very rare combination. Now, as you're going to find out here today, he knows the tax law when it comes to business owners and investing better than anybody else I've ever met. In fact, we're going to be diving into a few topics today, including how to build tax-free wealth legally, what the recent big changes in the tax law mean to you as an entrepreneur, especially if you run a business with any kind of physical product inventory, and last but not least, why are so many internet marketers always driving around in those damn Lamborghinis in their videos? Well, the answer might surprise you, and I'll just say this. This episode could literally save you tens of thousands of dollars or more in taxes, so listen up, grab a pen and paper, and without further ado, please help me welcome Tom Wheelwright. My old friend, Mr. Tom Wheelwright, welcome to the podcast, my friend.
Hey, thanks so much, Mike. It is always good to be with you, pal.
Yeah, likewise. It's been a few years. We got to hang out at South by Southwest for a little bit last month, and it's coming up to tax season, so I couldn't think of a better guest to have than you. For people who don't know, Tom was one of our advisors and content contributors way back in the Elevation Group days, probably 6-7 years ago now. And he is an advisor to the Rich Dad Poor Dad Group, and Robert Kiyosaki does a lot of speaking from stages with Robert around the world on taxes. And so, Tom, welcome, brother.
Hey, thanks, pal. It's always good to be with you. It was great catching up with you at South by, and always good to see you, talk to you.
Yeah, so we're coming up on tax season here, and this is a very big piece of everyone's lives, especially if you are a business owner, and you've really been teaching and preaching a methodology or strategy that you call tax-free wealth. So this is going to be an unbelievably valuable episode for everybody listening. Get ready to take some notes, guys, because this could really end up being worth millions and millions of dollars to you over the course of your career. So pay attention. So, Tom, with that being said, brother, dive in and let's go for it.
No, I appreciate it. And if you're a business owner or you're an investor, these are good times from a tax standpoint, because the new tax law, we actually released a new edition of tax-free wealth just because the new tax law had such an impact on business owners and investors. And for those of you who don't know, in tax-free wealth, we describe the tax law as a series of incentives. And while it does raise revenue for the federal government, the primary purpose of the tax law is to guide the economy, guide a lot of the social and even international aspects of the U.S. government. And so really our job as taxpayers is to partner with the government and do what the government wants us to do. And when we do that, we end up with, as we like to say in my company, Wealthability, we end up with a lot more money and a lot less tax. And that's really the goal here. And the reality is this is very doable. And there are some new opportunities in this new tax law for business owners and particularly real estate investors and retailers that are pretty astounding, Mike. I mean, it's like, seriously, I mean, we have clients now that retailers and real estate investors, they'll pay no tax and just all in 1 year. This hasn't even had to build over years, which normally, we do a strategy to build it over a number of years. This year, it's like, wow. I mean, the tax reduction opportunities are mind-blowing.
So give us the 50,000 foot overview of how to create tax-free wealth, and then let's dive into the specific updates you're talking about.
So, when you look at building wealth, right, you're looking at what's my return on investment. You look at how much money do I have available to me to invest, whether it's my money or somebody else's money. And you're looking at a long-term strategy. And long-term may be 5 years. Okay. I mean, for our clients, typically it's 5 to 7 years is their long-term strategy. Some people it's 30. We prefer the 5 to 7 year plan to the 30-year plan. The reality is that taxes are your single biggest expense. And if you can recover some of that tax money, or in many cases this year, all of it, and use that money towards building wealth, then that's actually something the government wants you to do. And it's something that is legal and something that is very doable. And if you combine that with the concept of leverage, which is using other people's money, and you take that tax money and use other people's money, then what you end up with is massive amounts of wealth potentially in a very short period of time. And like I said, I mean, historically, that's taken, takes 3 to 4 years to go from paying high taxes to paying low taxes or no taxes. This is a unique opportunity from the 2017 Tax Act to do it all in one leap.
So what are, let's take the next dive in and go a little bit deeper. What's changed specifically and how do we take advantage of it?
Well, so what we've always had is we've always been able to deduct expenses. And these are, money we spent that's going to be used up within the next 12 months. We've always been able to do that for both real estate and business. And frequently, there are other expenses we've been able to deduct even if we don't have a business or an investment, an active investment like real estate. What changed fundamentally in 2017 is we went from an income tax, which was net of our expenses, to a consumption tax. And we frequently think of a consumption tax as a value-added tax or a sales tax. In this case, the 2017 Act actually took our income tax and turned it into a consumption tax. And the way that the government did this is they said not only are expenses, business expenses deductible, but for the most part, business assets are deductible. And a big one, for example, is inventory. So historically, you've got a online business or you've got a retail business. The biggest challenge is that you're paying for your inventory on after-tax with after-tax dollars because your inventory historically hasn't been deductible until you sell it, which means if you're a growing business, then you're always paying tax on money you don't have. And this has been a big complaint of business owners for many, many, many years. And I've seen businesses that just, they'll come to me and say, I don't understand. I have a big tax bill, but I have no money.
Yeah, this has always been a huge issue for like health and supplement companies.
Exactly.
Right.
Or any kind of e-commerce, the Amazon retailers. It's been a big issue for, right? Where you're building your inventory, because, you have to have the inventory on hand, right? It's not like we're actually Amazon where we get it that day, right? I mean, typically we're building up that inventory. I mean, for example, I've got a group of clients that own pharmacies. Well, they're essentially retailers, right? They sell drugs. That's their retail business. And they've got all these drugs on the shelves and they can't, historically, they haven't been able to deduct them until they sold them. And that's a big burden. That's been a big burden for retailers. Yeah.
I mean, I've just heard nightmare stories from friends who are like, if we don't sell this $100,000, $1 million worth of tea or weight loss pills or whatever by the end of the year, we're paying taxes on it and not making the income for it. And so that's why you would always see these giant sales at the end of the year so that they could just liquidate as much of that as possible just for tax reasons.
No, that's exactly right. So I was at a conference the other day and I ran into a couple of pharmacists that I'd met in previous years, not clients, but people I'd met, very nice guys. And they told me this story and they said, it was November, December, and we went into our accountant, our CPA, and we said, what do you think we're going to owe for 2000, when we come April 15th of 2019 for our 2018. And he did the calculation, and the CPA says, you're going to owe $400,000 in tax. And they just their heart sunk. They go, that will put us out of business.
Yeah.
That is the end of our store if we owe $400,000 in tax. I mean, typical pharmacy doesn't make $400,000 of profit.
Right.
So then they go, they were thinking about it. They go, you know what? One of them says to me, I remember that, Tom, you did a webinar back in October that talked about some change in the tax law that might help, where we could actually deduct our inventory when we buy it instead of when we sell it. And so they asked their CPA, please take a look at this. And CPA said, no, we need to keep our inventory. It's okay. You guys will be able to manage and everything. And they said, no, please go back and look at this issue. Can we now deduct our inventory, like Tom says, when we buy it? And a couple of weeks later, they were driving down the road, and the CPA calls them. They happen to be in the car together. CPA calls, says, I need you to pull over. And they go, well, just tell us whatever it is. No, I need you to pull over. So they pulled over, and the CPA says, not only can you deduct the inventory, you have to do this. Because if you deduct your inventory like is allowed now, your tax bill will go from $400,000 to $45,000. And they came up to me. They were practically in tears. They said, Tom, what you taught us saved our business. And I'm going, that is the impact of taxes.
So let's give credit where credit is due. I assume this is a Trump administration change?
This is a Trump administration change.
All right. So wherever you're at on the side of the aisle, everybody owes some gratitude to President Trump for this, because a lot of the IRS's policies are just absolute asinine, like the one it used to be. And now, hey, there's a little bit of sanity involved here. So that's great to hear. Any changes or updates that would impact those of us like me in the info space?
No,
you're out of luck. I'm just kidding.
Absolutely. So let's move on. Okay, so for sure. So Mike, I know you like cars.
Yep.
So like I do, and they made a change in how cars are deducted for business purposes, which is fantastic. Okay, now Mike, you and I have talked about home office for years, and I know home office is a big part of your home is your office, same as me. And what most people don't consider is that a home office has a huge impact on your deduction for your car, because the IRS says that the first trip you take during a day from your home to your business is a commute, and the last trip home is also a commute. Well, what happens is if you have a home office, now your commute is 30 feet both ways, right? Yep. So now that first trip of the day when you're driving, probably most of the time you're driving, Mike, I'm guessing is going to be business now, because you're driving from your home office to some business event, meet somebody, do some filming, whatever it is. And that's going to be a business expense. Well, here's where the Trump tax law makes a big difference. We used to deduct those cars. I mean, you remember, Mike. I mean, we got like $3,000 a year, right? That was it. And then if you bought an SUV, you could, or a truck, over 6,000 pounds, you could deduct up to $25,000. But, you're buying a $100,000 SUV, a really nice truck, then you only get deduct $25,000. Now we have what's called bonus depreciation, and bonus depreciation is like a windfall. Start with your car. Now you buy that truck that's over 6,000 pounds, got to be over 6,000 pounds. Bonus depreciation says you get to deduct the entire truck year one. So even if it's a $100,000 truck, that's a $100,000 deduction. Even if you didn't pay for it and you borrowed all the money from the bank to pay for it, it's a $100,000 deduction. It's only deductible to the extent you use it for business, But if you have a home office, you may be using your car for business somewhere between 80% to 100% of the time. So if you're buying an SUV or truck, that's a big deal. Let's say you're buying a car, a passenger car. Instead of a first-year deduction of a few $1,000s, now even a passenger car first-year deduction is $18,000. And then it's about $10,000 a year after that. So the automobile deduction went way up under the Trump tax law. So that's something I would think would have an impact on you info people.
Yeah, and you know what else that I would love your clarity on? Because this has been a gray area. It's like the different CPAs I've talked to about this have always had somewhat of a different opinion about it, depending upon their risk tolerance. And that is the use or the ability to deduct your cars, or let's say your boat or your beach house or whatever for business purposes, if you're using those items in your marketing materials for customer acquisition. So for example, like getting the Self-Made Man race car, putting the logos all over it and putting it in our marketing videos, things like that, getting the boat wrapped with the company logos, putting those in our marketing videos. Depending upon who you ask, I get two different answers on that. So what's yours?
So that is a gray area. You're exactly right. I mean, most of the law actually is pretty black and white. That's a pretty gray area because that's a judgment call. So the question is, so we kind of have to step back and look at what's required in order for an expense to be deductible. And there's, four basic requirements, documentation being one of them. But the other three requirements are it has to have a business purpose. That's easy. You've already established that. You've wrapped it in your logos and everything else. There's clearly a business purpose there. The next one is it has to be ordinary. Now, ordinary means typical. So the question is, would it be typical in your industry to use a boat for marketing? Well, so let's take an example, a race car, okay? Pennzoil wraps the race car in marketing materials. Is that typical?
Sure.
Absolutely.
Yeah.
Not even a question. Okay. I go and take a race car as a CPA and I wrap my logos around it and we race it. Is that typical? I would say probably not. Okay. That's a little tough for a CPA, which by the way stands for cheapest people in America, to go out and, have a race car advertising. I'm a CPA for race car enthusiasts. I mean, maybe. The way I always look at it is the question is really not, is it deductible? It's how do we make it deductible? And the way to make that deductible is to show that, for what I'm doing, this is an ordinary and necessary business expense. I mean, even just having that car, let's say you've got a Ferrari, okay? So you got a $250,000 Ferrari. Well, the average person, has a $250,000 Ferrari. It may not be typical in their business to drive a Ferrari. Certainly, let's say you were a real estate agent. Ferrari would not be typical, more likely an SUV, right? On the other hand, take somebody like my friend Robert Kiyosaki. For him to drive a Ferrari, or you to drive a Ferrari, that's part of your brand image to drive a Ferrari.
Yeah, so that's what a lot of people don't understand. Like when people see Ty Lopez with his stable of like 8 supercars, or if they see Dan Lok doing his Boss in the Bentley videos or whatever it may be, and they rag on these guys and just, think that they're flashing and being egotistical or whatever, what they're missing and what they don't get is that the reason they're showing those cars in those videos, too, one, they're selling an aspirational lifestyle. Right. And 2, they're demonstrating their expertise and, their ability to make money. But 3, using those cars in those videos allows them to write them off as a business expense. And so even if, you want to take a more measured, conservative approach, you don't want to, quote, show off, then you're not being as smart and resourceful as you could. Because if you put those cars in your video, you could write them off as a business expense if that's the kind of education that you're providing, essentially, quote unquote, how to make money, right? And I've always I've always argued, well, would people buy my product if I were rolling around in a 1998 Honda Accord? No,
probably not.
No, right? So that's my argument. It's like if I'm selling how to make money in an aspirational lifestyle, then showing that off, whether it's through the boat or the cars or whatever, is a necessary part of my marketing. So, yeah.
Sure. I mean, I look at it, I mean, J-Lo is, working out and doing all that kind of stuff. I would expect that she's deducting that because that is part of her image. That is part of what she does. And I think that would probably be an unnecessary expense for her. For me, not at all. Okay. It's not part of my image. It's not it's not critical to my success. So you really do have to look at when they talk about ordinary and necessary, they're talking about your specific industry. Now, the challenge, of course, you always have, and don't forget this, is that the IRS auditor who is auditing this makes $60,000 a year.
Yeah.
So they are not going to be friendly about this. And so what that brings you to is you really need to have a tax advisor that can really work with that IRS agent and help them understand, that this would not be ordinary and necessary for me as a CPA.
Yeah.
Put you in their light. Can you see perhaps though that Mike Dillard doesn't get the subscriptions, doesn't sell the info products unless he has this. So even if he didn't have the money, he'd need to have this. And that's something that is, that's why how you support that audit is going to be really, really important. And it even is a matter of how you do report that on your tax return, because, tax returns can be prepared a lot of different ways, Mike, and how you prepare it has an impact on whether you're audited in the first place. So all of those things I think you have to consider. But I agree with you, Mike. I think there are absolutely people like yourself that if, you're doing this because you're trying to inspire people, that's an inspiration. And it's important for them to see that. That's why it's important to put in the video. Right. Not because putting the video gives you the tax deduction. It's because actually using it to inspire people is that by itself is what creates the tax deduction. So whatever will make you money is deductible. That's really the simple way to think about it.
Yeah. And that's what I want to bring some awareness around this to people, because I see a lot of people throwing judgment at other people, with the plane, like Grant Cardone and his new private jet right now. There's a reason he's got his logo on the tail and why it's in all of his videos. He's writing the whole damn thing off, right? So just have a little bit of awareness when you see this stuff and not just take it at face value, because those guys and gals are being smart when it comes to business and taxes, and that's why they're doing that. So
right. And let me add just one more thing on that, and that is that Grant Cardone, just putting his logo on the plane really isn't enough. Yeah. What's important is that there's a reason that he needs to have that jet, that it makes him more productive to have that jet. So, the difference between having a Honda or a Lamborghini is, image, but the fact of having a car, in some countries, cars are considered luxuries. In Chile, a car's a luxury. You don't get to deduct it.
Yeah.
Because the definition of luxury includes a car. So, we're okay in the U.S. Everybody has a car. The question is it used for, is it really used in the business? So, to have judgment over that is, I think silly. But because that's the way the tax law works. If it works for you to make money, it's probably deductible.
Yeah. So you've always kind of had a special skill set when it comes to dealing with auditors. So whenever you've had clients audited, I don't know if your track record is still intact, but I remember it was pretty phenomenal these days. So has that kind of continued?
Oh, sure. There's some science to it. There's also an art to it. I think the biggest part about protecting yourself from an audit is how the tax return's prepared. You know, I was telling a client this morning who's a brand new client, we're just starting to prepare their tax returns for 2018. And I said, look, we prepare every tax return as if it's going to be audited, every single one. So I'm going to ask you to make sure there's documentation. I'm going to make it look right. I'm going to anticipate that being audited, even though, I mean, I haven't handled an audit in years. Frankly, I just haven't had a client that's been audited in years because of how you prepare the tax return, right? But if we are audited, we want to be ready because it's really hard to go back. Second of all, how you actually sit down with the auditor. I mean, just a quick little story. I had an audit a number of years ago where the auditor had audited the business first, and the business was owned part by my client and part by another CPA's client. And the auditor first thing said was, I asked, how'd the business go? Because I wasn't involved. And the auditor says, oh my heavens, that other CPA was so mean, he made me cry. And I'm going, okay, well, I guess that's one approach. Now I happen to know the other CPA and actually didn't surprise me. But what I did is I take a very different approach. I go, well, that's not my job. My job is to actually help you do your job. And I'm here to make your job easier. That same auditor later on, because there was a very difficult issue in it, asked me to write her report. And that's just because of how I treated her. I mean, she was actually great. She wanted to learn. She was interested. She at the end, she goes, I totally agree. I totally get what you're saying. She goes, but there's no way I could write that up. Would you write it up for me?
Wow.
And I said, sure, I'm happy to.
Yeah. Yeah. Very cool. So I want to, well, actually, before, we've got two ways we can go here. Are there any other updates that are new and noteworthy that you think people should know about?
Yeah, I think a big one is for real estate. Because a lot of people, they might have an info business or they have another business, but they've invested in real estate. And we have the bonus depreciation that applies to cars for the first time ever applies to used real estate. So that means that Grant Cardone, speaking of which, goes out and buys that apartment building. What's going to happen is, rather than deduct, say, 5% a year of the cost of the building as depreciation, so he buys a $10 million apartment building, instead of a $500,000 deduction on that $10 million apartment building, he's probably going to get a $3 million deduction, because bonus depreciation now applies to all the contents of the building. It applies to the landscaping. It applies to the lighting outside. It applies to the fencing. It applies to the covered parking. It applies to so many items that if you do this, what we've always told people to do a cost segregation where you break it out, but with a professional. But the bonus depreciation is absolutely astounding. It tends to be somewhere between 20 and 30% of the purchase price of a property. Beginning in October of 2017, you buy a property, whether it's new or used, and you do a cost segregation, you're going to find about 20 to 30% of that purchase price is deductible year one. And that is think about this. Let's say that you put down $100,000 on a $500,000 property. If you get a 30% deduction, that means that you put down $100,000, but you get a $150,000 deduction. That's better than oil and gas.
Yeah.
So that's a big deal. That's a really big deal.
Yeah, no, definitely. And I'm thinking here as well, another question for you. Can you fill us in on research and development write-offs? Specifically, for example, let's use the Self-Made Man software platform that I developed over the last 2 years, right? So put somewhere close to $1 million into development of that. It's all proprietary code, that we built from scratch from our needs. And so how would that be handled?
So actually you have two different opportunities here, Mike. The first is software that you develop by definition is deductible. So you get to deduct the software development. So that's an easy one. The next thing is we have a research and development tax credit. And research and development tax credit applies to an increase in research and development costs. Now, this is something that, just like a cost segregation, you must have a professional do it. There have actually been a lot of cases lately on the IRS has actually included research and development in its dirty dozen of things that it is going after, because what's happening is CPAs, tax preparers, they're kind of putting their thumb up in the wind and say, well, I think it should be about this. That does not work. You really must hire I won't even do a research development study. That I sub out to another professional. That's all they do, because it's a very detailed analysis. But it's anywhere from 6 to 10% of that cost is a credit. And a credit, instead of coming off, instead of a deduction against your income, so it's subject to whatever your tax rate is, a credit is dollar for dollar. So literally, if you got a 10% credit for your software development, then that would be $100,000 against your taxes. It's a big deal.
Yeah, absolutely. And I believe we did that with Evergrow, with the development of the hydroponic system, because that clearly fell under that flag. So I want to take things up to a higher level here and just give people, again, kind of a 50,000 foot overview. How do you create tax-free wealth? Like, if you could break that down for us in a 10 to 15 minute strategy, what does that mean?
Well, so the first thing you have to do is you work with a tax advisor who will look at the big picture, because you really have to start with that 50,000 foot view. So we actually start by looking at, first of all, where are you today? So I want to know all your assets, your liabilities. I want to know your family situation, because that's going to have a tax impact. I want to know everything I can about you. And then we're going to look at, where do you want to go? And, most people don't know where they are in the first place, but almost nobody has a clue as to what their target is. What kind of a lifestyle are you looking for? And when do you want it? I mean, is this something that you're thinking, well, 30 years down the road, if I can retire and not live on a bench, right, or under a bridge, then I'm good. Well, if you do that, then you probably just need a financial planner, right? You don't actually need to develop a strategy for tax-free wealth. But if you're looking at, man, I would really like to get out of the rat race in the next 5 to 10 years, then you start with, okay, so if that's what it takes, it's all about the numbers. So you have to look at, what is that lifestyle going to cost? And whatever that lifestyle costs, that's the passive income that you're going to want to have in order to, really live your dream. And the best way to do that is tax-free. So you look at where you are and where you're going from a wealth standpoint, and then what you have to do is you have to start narrow it down and say, okay, how am I going to build that wealth? Am I going to build it through my business? I'm going to build it through real estate. I'm going to build it through commodities. Am I going to build it, through the stock market? How am I going to build that? How am I going to build that wealth? And then actually get very specific in your criteria for the building wealth. Once you have that, then we can look at the tax piece. But until we know that picture, I mean, literally you're 50,000 foot. Until we know that picture of how you want to build your wealth, because everybody's different. I mean, Mike, yours is in info, mine's in tax, building a network of CPAs. Somebody else is in Ken McElroy, my buddy Ken McElroy, it's in real estate. Grant Cardone, it's real estate, right? So how you're going to do it, it's going to be different for everybody. But once as your CPA, once I know how you're going to do it, now I can look at, okay, so how do we make that tax effective? Okay, and tax effective means tax free. So if it's your business, I'm going to look at things like we talked about, your inventory, your research and development, because it's one that a lot of people miss. Your assets, what assets could actually be deducted? Because what we want is, the faster we get the money. So even if it's a deferral, so even if we're saying, well, yes, we're going to deduct a whole bunch of depreciation this year, bonus depreciation, but we know that somewhere down the road, right, we're going to have to pay, we may have to pay that back. There's actually a way not to pay it back. But we may have to pay that back. That's okay, because we want our money now. Because financial growth and really building wealth is about, it's kind of it's about mass or volume. How much do I have now? Because 2% of 10 million is just a lot more than 2% of 100,000. So we want it now. Then what we look at is we look at all of the tax consequences, and we really walk through. There's 5 ways. It's very simple. There's 5 ways that you can save taxes, and only 5 ways. The first is deductions. Most people are pretty familiar with that, but employees don't really get deductions anymore. So you either got to be a business owner or a professional investor. Then we look at the type of income we're earning. So you can earn high taxed income, which is like earned income, or no taxed income, which is like real estate income, right? Passive income. So we look at the type of income, or is there a way to convert our ordinary income to some other type of income, like capital gains, for example. If I can convert income from ordinary income to capital gains, I can cut my tax rate in half on that income. So we look at that. We call that conversion. Then we look at tax brackets. Most people are supporting somebody else, whether it's a child or whether it's an elderly parent. They're supporting somebody else, and they're not getting the tax benefit that they should be getting, either for the money they're contributing, which there's a way to get that deductible, or because they've got a business and let's say the elderly parents, they have a low tax bracket, you're giving up a tax bracket. So we look at the tax brackets that we have available to us. These are underutilized or non-performing assets, tax brackets, that we have available to us. The fourth way is tax-free income. So we look at whether it's life insurance, we've talked about that before, Mike, whether it's life insurance, whether it's real estate income, which because of depreciation should be tax-free. There's all sorts of tax-free income. And then we look at, if all else fails, we'll look at things like pension plans, profit sharing plans, ways to defer. So one of those 5 ways, as we walk down the list, what's going to happen is your taxes, we find that when we start with a new client, within 3 months, we're going to reduce your taxes by 10 to 40%. Within 3 to 5 years, if you're a serious investor, then you can, if you choose so, take the actions that it takes. Because if you want to change your tax, you have to change your facts. If you're going to do that, if you want to do that, we literally can get to tax-free. I mean, I've got 2 doctors right now that I'm working with, and doctors are really hard to deal with tax-wise. And we're going to get them to tax-free within 3 to 5 years. And that's the goal. Because once you're tax-free, basically you can stay tax-free, right? Once you get there, you can stay there.
Very cool. Very cool. Oh man, we've covered a lot. Is there anything that we haven't gone over yet that you think is pretty critical?
I think that the most important thing people can do is just change how they think about taxes. It's kind of like, a lot of people read Rich Dad, Poor Dad, right? There's no content in that book. I've read it many times. I've helped edit the new version of it, the anniversary version. There's no content in Rich Dad, Poor Dad. It is all context. It's how do you think about money? And I've seen people, all over the world, people come up to Robert Kiyosaki when I'm traveling with them and say, "You changed my life." Well, all he did was change the way they think about money.
Right.
If we can change the way we think about taxes, that this is not something that they're out to get you, but rather this is something that is a tool to use. Now, all of a sudden, the tax law becomes a positive instead of a negative. We take a lot of stress off ourselves because now it's a positive. We realize that, all these tax benefits that people complain about, they're intentional. These aren't loopholes. These aren't mistakes that the government made. The deducting inventory isn't a mistake. That's something they wanted to do. Deducting bonus depreciation, deducting a car, those are things the government intentionally put into the law. Reducing the corporate tax rate to 21%. That was intentional, right? So these are intentional tax benefits. And to say, well, that's illegal or that's wrong. I can't tell you, Mike, every single time I speak, I'm not kidding. Every single time I speak, somebody's going to come up to me afterwards and say, "That's illegal. You can't do that here. That's not possible." And I'm going, well, it's not possible to you, but it's possible to me because I understand the tax law.
Yeah.
And if you look at it as, you know what, there was a judge back in the 1930s, his name actually is Learned Hand. And he was an appellate court judge, and he said, look, nobody's required to pay more taxes than they have to. And in fact, nobody will. I mean, the same people who complain about the Grant Cardone airplane, right, Mike, being deducted, those are the same people that I guarantee you they deduct their 401k. I guarantee you they deduct their home mortgage, and they're complaining because they don't get to deduct their state taxes. Well, they're all incentives, right? The government gives incentives, they take away incentives. The government, and I'm still laughing about this, is that the government took away the incentive to live in New York or California.
Yeah,
they did.
Yeah, they all moved to Austin.
and that's true. They started moving to Phoenix, and then they said, Phoenix is full. Let's move to Austin. It's cool. So I know they're coming in droves to Austin, but that's literally because Texas is a zero tax state, and that's a lot of what drives it. So for people to think, well, taxes don't drive behavior. I mean, come on. Yeah. Taxes have a big impact, and the government knows this, and it doesn't even matter what country you're in.
So
every government does this.
There's an entire new high-rise under construction right now that Google's going to own in Austin. There's an entire massive Oracle campus being built. There's about to be a huge Apple campus under construction here. And Facebook's here as well. So they're all moving to Austin specifically for that reason.
Yeah, for sure. I mean, you saw what happened with Amazon in New York, right? I mean, those people are crazy out there. But, tax incentives work. Yeah. They do. And the government knows it. And so why, here's the thing, Mike. Every one of us is a partner with the government. We're all partnering. I mean, you look at your paycheck, the government took a piece out of your paycheck. Yeah. So the government is your partner, whether you like it or not. And really, you have a choice of what kind of a partner you're going to be. Are you going to be a good partner or a bad partner? If you're a bad partner, you're going to pay high taxes. If you're a good partner, you're going to pay no taxes.
Yeah.
That's how it works.
Yeah, absolutely. Well, awesome, brother. Where can people reach out to you if they want to talk to you about their taxes? Maybe hire you as a CPA or one of your CPAs within your network. What's the best way to get a hold of you?
So thank you for asking that, Mike. I really appreciate it. Wealthability.com. Wealthability is our company, wealthability.com. And we do, as Mike said, we have an entire network we are building. We have 11 CPA firms. We are building it. We'll hit 100 by the end of the year. So it doesn't matter where you are, technology as it is. I mean, Mike, you and I aren't in the same room today. So you don't need a local CPA. That's crazy these days. What you need is somebody who understands the thought process, the context of tax-free wealth. And that's what we're teaching our network. So if you have an interest in that, if you just, our the audio version of the second edition of Tax-Free Wealth is coming out. That's coming out in first part of April. It'll be out. So whatever way we can help you, that's really, we have a mission here, and our mission is helping people develop tax-free wealth, and that's it. So whether it's, whether we can serve you as what you're a client, whether we serve you through education, whatever we can do, we're happy to do that.
Very cool. Awesome, brother. Well, thank you for joining us and bringing us up to speed. I know this is going to thrill all of the business owners out there who specifically have physical product goods companies in the e-commerce space. And maybe, someone who wants to go buy that new fancy car they've always wanted, and now they've got a bigger incentive to. So
there you go.
Yeah, I appreciate your time today. Thanks for joining us as always. Guys, go connect with Tom if you need some help with your taxes. If you're doing your taxes with kind of your local, retail franchise and you own a business, you're making a huge mistake. I would call Tom and get your shit squared away because you're leaving money on the table. I can promise you that. Thanks again, Tom. Appreciate you, brother.
Hey, thanks, Mike.
Okay. We'll see you next week, guys. Take care.